Listen, I'm going to tell you something right now that's going to save you years of frustration, thousands of dollars in losses, and countless sleepless nights staring at your trading screen wondering why the market keeps punishing you. You ready? Here it is. The higher time frame is always right, and you are always wrong when you fight it. I don't care how perfect that 5-minute setup looks. I don't care if you got 20 confluences on the 1-minute chart. I don't care if your favorite indicator is flashing green like it's Christmas morning. If the higher time frame is telling you something different, you are about to get your face ripped off. Period. End of story. You know what separates professional traders from retail traders? It's not intelligence. It's not capital. It's not some secret indicator or magical entry technique. It's the discipline to respect the hierarchy of time frames. The professionals know that price action operates in a top-down structure, and that structure is absolute. The monthly tells the weekly what to do. The weekly tells the daily what to do. The daily tells the 4-hour what to do, and so on, all the way down to whatever intraday time frame you're trying to scalp on. Let me break this down for you in a way that's going to fundamentally change how you look at charts forever. When you open up a monthly chart, you're looking at institutional positioning. You're looking at where the smart money, the banks, the hedge funds, the market makers, where they've decided price is going for the long term. These are not short-term plays. These are structural moves that represent billions of dollars in positioning. When you see a monthly fair value gap, that's not just some random inefficiency. That's a magnet for price that will draw the market back to it, sometimes over the course of months or even years. Now, the weekly time frame breaks down that monthly intent into more manageable pieces. Think of it like this. The monthly is the blueprint for the building, and the weekly is showing you which floor we're working on right now. The weekly time frame shows you the intermediate structure, the major swing points, and where the institutional order flow is really sitting. When you've got a weekly order block that hasn't been tested yet, that's a level that price will respect. Not might respect, will respect. The daily time frame is where most swing traders should be making their trading decisions. This is where you can see the daily bias, the daily structure, and where the market is likely heading over the next several days to weeks. But here's what most traders get wrong. They treat the daily chart like it's independent of the weekly and monthly. They see a daily support level and think, great, I'll buy here, without ever looking up to see that the weekly chart is in a massive bearish trend with untouched supply zones above. That's not trading. That's gambling with extra steps. The 4-hour and 1-hour timeframes are where you start to refine your entry timing. But I need you to hear this. These are not decision-making timeframes. These are execution timeframes. You don't decide your bias on the 4-hour chart. You confirm it there. You don't decide your target on the 1-hour chart. You refine your entry there. There's a massive difference. And if you don't understand that difference, you're going to keep getting chopped up. And then we get to the 15-minute, 5-minute, 1-minute charts. These are the time frames that most retail traders live on. These are the time frames where you think you're seeing setups every 10 minutes. Let me tell you what you're really seeing. Noise. You're seeing algorithmic movements. You're seeing stop hunts. You're seeing liquidity grabs. And you're seeing the market do exactly what it's designed to do, separate you from your money by making you think you found an opportunity when really you found a trap. The intraday timeframes are useful for one thing and one thing only: precise entry execution on a bias that has already been determined by the higher timeframes. That's it. If you're using a 5-minute chart to decide whether you should be long or short, you've already lost. You just don't know it yet. Here's a real world example that I want you to burn into your brain. Let's say you're looking at EUR USD. The monthly chart shows you that we're in a bullish market structure. We've taken out the previous month's high. We've got a clean bullish order block on the monthly, and there's a massive fair value gap below that hasn't been filled yet. That monthly chart is telling you this market wants to go higher. Now you drop down to the weekly. The weekly shows you that we just had a retracement into a weekly demand zone. We've swept weekly lows, grabbed liquidity, and we're starting to show signs of reversal. The weekly is confirming what the monthly is saying. This market is getting ready to continue higher. Daily chart, you see a daily bullish break of structure. You see a daily order block that price is tapped into. You see clean bullish market structure with higher highs and higher lows. The daily is in complete agreement with the weekly and monthly. Everything is aligned. Now, the 4-hour chart. You're watching price pull back into the daily order block. And on the 4-hour, you see a smaller retracement that's giving you a fair value gap to work with. The 4-hour is showing you where your execution zone is, not your decision zone, your execution zone. And finally, you drop to the 15-minute or 5-minute chart to time your entry precisely. You wait for a sweep of short-term lows. You wait for a reversal pattern. You wait for whatever specific model you use to time entries. And then only then do you pull the trigger. That's how you use time frames properly. Top down, always top down, never bottom up. But what do most traders do? They flip this entire process on its head. They're sitting there on the 5-minute chart. They see a little double bottom or some candlestick pattern they read about in a book, and they go long. They never check the daily. They never checked the weekly. They never checked the monthly. And then they wonder why their perfect setup got destroyed. The market doesn't care about your 5-minute setup. The market doesn't even know your 5-minute setup exists. The market is being driven by orders that were placed on the daily, weekly, and monthly timeframes. Those are the orders that matter. Those are the orders that move price. Your little 5-minute long position is a mosquito trying to stop a freight train. Let me give you another way to think about this. Imagine you're trying to swim in the ocean. The monthly chart is the tide. It's either coming in or going out, and you're not going to change that. The weekly chart is the waves they're moving with or against the tide, and they're powerful. The daily chart is the current. It can pull you along or push you back. And the intraday charts, those are the ripples on the surface. You can splash around in those ripples all you want, but if you're swimming against the tide, against the waves, and against the current, you're going to drown. It doesn't matter how hard you swim. The hierarchy of truth in price action is non-negotiable. Higher time frames contain more information, more volume, more institutional positioning, and more significance than lower time frames. Always. This isn't up for debate. This is market structure 101. When a higher time frame contradicts a lower time frame, the higher time frame wins every single time without exception. You can take that to the bank, or more accurately, you can save your bank account by understanding it. So here's what I need you to do right now. I need you to stop whatever you're doing and pull up your charts. Start with the monthly. What's the monthly structure? Is it bullish or bearish? Where are the key levels? Where are the fair value gaps? Where are the order blocks? Write it down. Then move to the weekly. Does the weekly confirm the monthly or contradict it? If it contradicts it, you wait. You do nothing. Then the daily, then the 4-hour. Work your way down and only take trades where every time frame from the monthly down to your entry time frame is in alignment. You do that, and I guarantee your win rate goes up. Your risk to reward improves. Your confidence increases. Your account grows because you're finally trading with the market instead of against it. You're finally respecting the hierarchy of truth that's been in front of you the entire time. The higher time frame is always right. Learn it, respect it, trust it. Your trading account will thank you. Now that you understand the hierarchy, let's talk about what you're actually looking at when you analyze higher time frames. Because here's the thing, most of you are looking at these charts completely wrong. You're seeing lines and candles and patterns, but you're not seeing what's really there. You're not seeing the story. You're not reading the institutional narrative. Every single candlestick on a higher time frame represents a battle between buyers and sellers. But more importantly, it represents billions of dollars in institutional positioning. When you look at a weekly candle, you're not just seeing price movement. You're seeing where banks place their orders. You're seeing where hedge funds accumulated positions. You're seeing where market makers provided liquidity. This is the footprint of smart money. And if you can't read it, you're trading blind. Let me explain something crucial. Institutions don't trade the way you trade. They can't. When a bank wants to buy $1 billion worth of EUR USD, they can't just hit the buy button and hope for the best. That kind of volume would move the market against them instantly. So what do? They engineer price movements. They manipulate the market legally, I might add, to create liquidity at the levels they want to trade at. This is where higher time frames become absolutely critical, because the manipulation patterns that institutions use are clearly visible on the daily, weekly, and monthly charts. They're hidden in the noise on the lower time frames, but they're crystal clear when you zoom out. Let's start with the monthly chart. When you're analyzing a monthly chart, you need to ask yourself 3 fundamental questions. First, what is the long-term trend? Second, where are the major swing points? Third, what inefficiencies exist that haven't been addressed? The long-term trend on a monthly chart tells you where institutional money is positioned for the macro move. If you've got a monthly chart that's been bullish for years, making consistent higher highs and higher lows, that's telling you that the big money is long. They're holding long positions, and every retracement is an opportunity for them to add to those positions. When price pulls back on a monthly chart in an uptrend, that's not weakness. That's accumulation. That's institutions using retail panic to buy more at better prices. The major swing points on monthly and weekly charts are where you find the most significant order blocks and fair value gaps. These aren't just support and resistance levels that you draw with a horizontal line and call it a day. These are zones where massive institutional orders were filled and where massive institutional orders are still sitting, waiting to be filled. When you see a monthly high that got taken out, you need to understand what happened there. Above that high, there were stop losses from everyone who was short. There were buy stops from breakout traders. There was liquidity, tons of it. And institutions used that liquidity to fill their sell orders if they wanted to go short or to push through if they wanted to continue higher. Either way, that swing point tells you a story about what the smart money did. Here's what separates professionals from amateurs. Professionals know that after a monthly high gets taken out, price will often retrace back into the order block that launched that move. Why? Because that's where institutions want to add more to their positions. That's where they have limit orders sitting. That's where they're engineering the next leg of the move. You see this pattern over and over again. Expansion, retracement, expansion. The initial expansion takes out liquidity and establishes the new range. The retracement comes back to institutional entry points, order blocks, fair value gaps, breaker blocks, and then the next expansion happens because institutions just loaded up more contracts at optimal prices while retail traders were panicking about the retracement. Now let's talk about weekly charts, because this is where you start to see the intermediate term narrative unfold. The weekly chart shows you what's happening quarter by quarter, month by month. This is where swing traders should be living. This is where you identify your trades that you'll hold for weeks or months. On a weekly chart, you're looking for the same things as the monthly, but with more granularity. You're looking for weekly market structure, a series of higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. But more importantly, you're looking for where that structure gets broken and why. When a weekly market structure breaks, that's a massive event. That's not noise. That's not a head fake. That's a shift in institutional positioning. When you see price break through a weekly swing low in an uptrend, that's telling you that the institutions who were long are either taking profits or reversing their positions. That's information you can't ignore. But here's where it gets interesting. After a break of market structure on the weekly, price will often do one of two things. It will either continue in the new direction aggressively, or it will pull back to the breaker block, the area where structure broke, before continuing. This pullback is called a retest, and it's one of the highest probability trading opportunities you'll ever find. Why? Because institutions know that retail traders think the old trend is going to resume. Retail sees the pullback and thinks, great, I'll buy the dip. They don't realize that the structure already broke. They don't realize that what was once support is now resistance. So they buy and institutions sell to them. They provide the liquidity that institutions need to add to their new positions. This is the game. This has always been the game. And it plays out on weekly charts with stunning clarity and consistency. Let me give you a concrete example. Let's say you're looking at GBP USD on the weekly chart. For 6 months, it's been in a bullish trend. Higher highs, higher lows, clean structure. But then 1 week, price takes out the previous weekly low. That's a break of structure. That's a shift. Now, what do most traders do? They panic. They close their longs. Or worse, they see the pullback that often follows and think it's a buying opportunity. They buy right into what was once a demand zone, not realizing that it's now a supply zone. It's now a breaker block. and then price rolls over and destroys them. What do professional traders do? They recognize the break of structure, they mark the breaker block, they wait for price to pull back into that zone, and then they short it. They're selling to all the retail traders who are buying, and they're positioning themselves for the next leg down. The daily chart is where you refine this narrative even further. The daily chart shows you the short to intermediate term positioning. This is where day traders and swing traders make their decisions about which direction they're trading this week. But again, and I can't stress this enough, the daily chart must be in alignment with the weekly and monthly, or you're fighting a losing battle. On the daily chart, you're looking for daily market structure, daily order blocks, daily fair value gaps, and daily liquidity pools. But you're not looking at these in isolation. You're looking at them in the context of what the weekly and monthly are telling you. If the monthly is bullish, the weekly is bullish, but the daily just broke bear structure, what does that tell you? It tells you this is likely a retracement on the higher time frames, not a reversal. It tells you that this bearish daily move is probably going to hit a weekly or monthly demand zone in reverse. It tells you to be patient and wait for that reversal before getting long. Conversely, if the monthly is bearish, the weekly is bearish, and the daily just broke bullish structure, you don't get excited about longs. You recognize that this is likely a relief rally into weekly or monthly supply. You wait for price to reach those higher time frame supply zones, and then you look for shorts. This is how you read the institutional narrative. You're not reacting to every wiggle on the chart. You're reading the story that's being written by the big money, and you're positioning yourself to trade alongside them. Fair value gaps on higher time frames are another critical piece of this puzzle. When you see a fair value gap on a weekly chart, that's an inefficiency that represents millions or billions of dollars worth of orders that didn't get filled. The market has an algorithmic tendency to return to these gaps and fill them. Not always immediately, but eventually. I've seen weekly fair value gaps get filled 6 months, a year, even 2 years after they were created. And when price finally reaches them, the reaction is often explosive because that's where institutional limit orders were sitting the entire time, waiting to get filled. You need to mark every single fair value gap on your monthly, weekly, and daily charts. You need to understand that these are magnets for price. And when price is moving toward one of these gaps on a higher time frame, you don't fight it, you trade with it. You look for entries on lower time frames that align with price reaching that higher time frame objective. Order blocks on higher time frames work the same way. A monthly order block is a zone where institutions entered positions with massive volume. When price returns to that zone, you can expect a reaction. Not a hope, not a maybe, an expectation based on years of observing this phenomenon play out consistently. But here's what most traders do wrong with order blocks. They treat them like they're brick walls. They think price hits the order block and immediately reverses. That's not how it works. Institutions need liquidity to fill their orders. So what happens when price approaches a higher time frame order block? Price will often sweep just beyond the order block to grab liquidity before reversing. It'll take out the stops of retail traders who were protecting their positions. It'll grab the stops of traders who placed them just below the obvious level. And then after that liquidity grab, the real move happens. The reversal from the order block occurs and institutions get filled at optimal prices. If you don't understand this mechanism, you'll get stopped out right before the move you were expecting actually happens. You'll place your stop just below the order block. It'll get swept, and then you'll watch in frustration as price reverses exactly where you thought it would, but without you in the trade. The solution? Place your stops beyond where the liquidity grab would occur. Give your trades room to breathe. Respect the fact that institutions need to engineer liquidity before they can move price in the intended direction. This is especially critical when you're trading off higher time frame levels because the liquidity grabs are larger and more violent. Here's the bottom line. When you're analyzing higher time frames, you're not looking at random price movements. You're looking at the footprints of institutional trading. Every swing high, every swing low, every gap, every order block, these are breadcrumbs showing you where the smart money is positioned and where they want price to go next. Your job is to read this narrative correctly and position yourself accordingly. Trade with the institutions, not against them. Follow the higher time frame structure, not the lower time frame noise. Trust what the weekly and monthly charts are telling you, even when the daily or intraday charts seem to be saying something different. Because at the end of the day, The higher time frames contain the truth. They show you where the real money is positioned. And if you align yourself with that truth, you'll find yourself on the right side of the market more often than not. Understanding the hierarchy and reading the institutional narrative is one thing. Actually implementing that knowledge into your trading decisions is where most traders completely fall apart. They know they should respect higher time frames. They nod along when they hear it. They might even believe it, but then they open their charts, see a setup on the 15-minute, and they throw everything out the window. Let me be brutally honest with you. If you cannot align your trading decisions with higher time frame bias, you will never be consistently profitable. You might catch a few winners here and there. You might have a lucky week or even a lucky month. But over time, over hundreds of trades, you will lose. The math is against you. The institutions are against you. The market structure is against you. You're fighting a battle you cannot win. So let's talk about how to actually do this. How do you take a higher time frame bias and translate it into executable trades on lower time frames? How do you maintain discipline when every fiber of your being wants to take that counter trend trade because it looks good? How do you filter out the noise and focus only on the opportunities that truly align with where the market wants to go? First, you need to establish your bias before the trading day even starts. Not during, before. This is non-negotiable. If you're sitting down at your trading desk and you don't already know what your daily bias is based on higher time frame analysis, you shouldn't be placing any trades, period. Here's how you establish that bias correctly. You start with the monthly chart. What's the monthly trend? What's the monthly market structure? Are we bullish or bearish on the monthly? Where are the key monthly levels, order blocks, fair value gaps, swing points? Write this down. Actually, write it down. Don't just glance at it and think you'll remember. Your brain will lie to you in the heat of the moment. Have it written down in front of you. Then you move to the weekly. Does the weekly confirm the monthly, or are we in a retracement phase? If the monthly is bullish but the weekly just broke bearish structure, you note that. That tells you we're likely in a pullback phase on the monthly, which means you're looking for the weekly to find support at a monthly or weekly demand zone before resuming the larger trend. Then the daily. What did the daily do yesterday? What's the daily market structure? Did we break structure? Did we respect a key level? Where's the next draw on liquidity on the daily? Where's the next fair value gap? Where's the next order block? By the time you've done this analysis, you should have a clear picture of what the market wants to do. You should know whether you're looking for longs, shorts, or if you're sitting on your hands because the time frames are conflicted. And here's the key. If the time frames are conflicted, you don't trade, you don't try to pick tops or bottoms, you don't try to catch reversals, you wait for alignment. Let me give you a real world workflow. Let's say it's Sunday night and you're doing your weekly analysis. You pull up EUR, USD, monthly chart is bullish, strong uptrend, respecting structure, well above key monthly support. Weekly chart just pulled back into a weekly order block and showed signs of reversal on Friday. Daily chart broke bullish structure on Friday, taking out the previous day's high. What's your bias for the week? Bullish. You're looking for long opportunities only. You're looking for price to continue higher, targeting the next weekly or monthly draw on liquidity. You mark your key levels, the weekly order block you just tapped, the daily order block from Friday. Any fair value gaps below that could be retested. These are your zones of interest for entries. Now, Monday comes. You drop down to the 4-hour chart. You're not deciding your bias on the 4-hour. You already know your bias is bullish. You're just looking for how the market is going to give you that long entry. Maybe price pulls back into the daily order block you identified. Maybe it fills a 4-hour fair value gap. Maybe it sweeps overnight lows before reversing. You're watching for these patterns because you know the higher time frame wants to go up. Then you go to the 1-hour or 15-minute chart for execution. You wait for price to reach one of your predetermined zones. You wait for a liquidity sweep. You wait for your specific entry model to trigger, and then you execute. Your stop goes beyond the invalidation point of the higher time frame structure. Your target is based on the next higher time frame objective, maybe the weekly high, maybe a weekly fair value gap above, maybe the monthly swing point. That's how you align your trading with higher time frames. You decide your bias on the higher time frames. You identify your zones on the higher time frames. and you only execute on the lower time frames when price is doing what the higher time frames said it would do. But let's talk about what you don't do, because this is where I see traders sabotage themselves constantly. You don't take counter trend trades. I don't care how perfect they look. If your higher time frame bias is bullish and you see a perfect short setup on the 15-minute chart, you ignore it. You walk away. You let it go. Because even if that short makes money, you're training your brain to fight the higher time frame, and that's going to cost you far more than any single winning trade could ever make you. You don't override your analysis mid-session. This is huge. The market has a way of making you second guess yourself. You come in with a bullish bias, price starts dropping, and you start thinking, maybe I was wrong. Maybe I should look for shorts now. No. If your higher time frame analysis was sound, temporary volatility on lower time frames doesn't change that. Price can pull back, price can consolidate, price can even sweep the lows you thought were protected. But if the higher time frame structure is still intact, your bias doesn't change. The only time you change your bias mid-session is if the higher time frame structure actually breaks. If you're bullish based on daily structure and the daily structure breaks, bearish actually breaks, not just pulls back, then and only then do you reassess. But you don't reassess because of a 15-minute move. You don't reassess because of a 1-hour consolidation. You reassess when the time frame you based your bias on tells you to reassess. Here's another critical point. You don't trade during time frame conflicts. If the monthly is bullish, the weekly is bearish, and the daily is chopping around, you have no business placing trades. You're in no man's land. You're in the zone where both bulls and bears can make arguments, and that's exactly where you get chopped up. Wait for the time frames to align. Wait for clarity. There's always another trade. I want to talk about something that's going to save you an enormous amount of frustration. Understanding where you are within the higher time frame structure, because a bullish bias doesn't mean you're buying everywhere. It means you're looking for specific zones where the higher time frame structure suggests you should be buying. If the daily chart is bullish, but price is at the top of the daily range, approaching a weekly supply zone, your bullish bias doesn't mean you start chasing longs. It means you wait. You wait for price to either break through that weekly supply convincingly, or you wait for a pullback to a better entry zone. Just because your bias is bullish doesn't mean every price level is a buy. Context matters. This is where most traders mess up with higher time frame analysis. They think higher time frame is bullish means buy everything. No, higher time frame bullish means you're only looking for long opportunities, but you're still being selective about where those opportunities present themselves. You're still waiting for optimal entries at key levels. Let's talk about targets, because this ties directly into higher time frame analysis. Your profit targets should be based on higher time frame levels, not arbitrary risk to reward ratios. I see traders all the time who will take a trade off a daily order block and put their target at 2-to-1 or 3-to-1 risk reward without even looking at where the next significant level is. That's backwards. Your target should be the next logical draw on liquidity on the higher time frame. If you're longing from a daily order block, your target should be the next daily high or the weekly high or a fair value gap above or a monthly level. Wherever the market is being drawn to next based on structure, sometimes that's 2-to-1, sometimes that's 10-to-1. Let the market structure determine your target, not some arbitrary ratio. Same with stops. Your stop should be placed at the invalidation point of your higher time frame thesis. If you're trading off a weekly order block, your stop should be placed where, if hit, it would indicate that the weekly structure has actually failed, not where you feel comfortable risking, not at some arbitrary percentage of your account, at the structural invalidation point. This is risk management based on market structure, not risk management based on fear or greed. And it's far more effective because you're allowing the market to tell you when you're wrong rather than taking yourself out prematurely because price did some normal volatility within the structure. Now, let me address something that's going to challenge your patience. Waiting for higher time frame alignment takes time. Sometimes you'll do your analysis on Sunday and you won't get a trade all week because the setup never forms. Sometimes you'll wait days for price to reach your entry zone. Sometimes price will reach your zone but won't give you your entry trigger. And that's okay. Actually, that's better than okay. That's professional trading. Professionals don't trade every day. They don't need to be in the market constantly. They wait for their setup, and when it's not there, they do something else. They study, they review past trades, they work on their psychology, they live their lives, but they don't force trades. Retail traders think they need to be in the market every session. They think if they're not taking trades, they're missing opportunities. But the reality is, the market is open 24 hours a day, 5 days a week. There are literally thousands of opportunities every week across all the pairs and instruments you could trade. You don't need to catch all of them. You don't need to catch most of them. You only need to catch the ones that align with your methodology and your higher time frame bias. One high quality trade per week based on solid higher time frame alignment will make you more money and save you more stress than 20 mediocre trades based on lower time frame noise. One trade where everything lines up monthly, bullish, weekly bullish, daily bullish, 4 hour giving you the entry, 1 hour timing, the execution. That one trade can run for days or weeks and give you profits that dwarf what you'd make scalping around on 5-minute charts. Here's your practical takeaway from this. Create a checklist. Before every single trade, you go through this checklist. What's the monthly bias? What's the weekly bias? What's the daily bias? Are they aligned? If not, where's the conflict and can I explain it? What are my key levels? Where's my entry? Where's my stop? Where's my target? What's my trade management plan? If you can't answer every single one of those questions with confidence, you don't take the trade. It's that simple. Your trading should be systematic, not emotional. You should be following a process that starts with higher time frame analysis and ends with precise execution on lower time frames. Stop fighting the market. Stop trying to predict reversals. Stop taking trades because you're bored or because you feel like you need to be doing something. Start respecting the higher time frames. Start trading only when everything aligns. Start being selective and patient. Do that, and you'll see your consistency improve dramatically. We've covered the hierarchy. We've covered reading the institutional narrative. We've covered aligning your decisions with higher time frame bias. But none of that matters, absolutely none of it, if you don't have the discipline to actually follow through when it counts. And that's where most traders fail. Not because they don't understand the concepts, not because they can't read a chart, but because when the moment comes to pull the trigger or stay patient, they fold. Let me tell you what's going to happen when you start trading with higher time frame bias. You're going to be in a trade, sitting on a nice profit, and the lower time frames are going to start flashing warning signals. The 5-minute chart is going to form a reversal pattern. The 15-minute is going to break structure against you. And every instinct in your body is going to scream at you to close the trade and take your profit. But your higher time frame analysis says the trade has room to run. The daily target hasn't been hit. The weekly structure is still intact. The monthly is still pointing in your direction. What do? You trust the higher time frame. You hold, you ignore the noise, because this is where the real money is made. This is where professionals separate themselves from amateurs. Amateurs get shaken out by lower time frame volatility. Professionals hold through it because they know the higher time frame is in control. I've watched traders take perfect entries off weekly order blocks, see the trade move in their favor, and then close it at the first sign of a pullback on the 4-hour chart. They make 20 pips when the trade had 200 pips of potential, and then they wonder why they're not making money. You're not making money because you're not letting the market pay you what it wants to pay you. You're taking scraps when the higher time frame is offering you a feast. Here's a hard truth. The market is going to test your conviction every single time. It's going to pull back just enough to make you doubt yourself. It's going to consolidate just long enough to make you think you're wrong. It's going to do exactly what it needs to do to get weak hands out of the trade before it makes the real move. This isn't random. This is deliberate. Institutions need to shake out retail positions before they can push price further. Why? Because retail traders are their liquidity. When you panic and close your long, somebody has to take the other side of that trade. And that somebody is the institution that wants to add to their long position. You're literally handing them your money because you couldn't handle normal volatility within the structure. The way you combat this is by having absolute clarity on your invalidation point before you enter the trade. Not a mental stop, not a vague idea, an actual level on the chart where if price reaches it, the higher time frame structure has failed and your thesis is wrong. And until price reaches that level, You hold. You don't care what the 1 hour is doing. You don't care what the 15-minute is doing. You hold because the higher time frame structure is still intact. Let me give you a real world example of what this looks like in practice. You take a long entry off a daily order block. Your stop is below that daily order block at the point where, if hit, it would indicate the daily structure has failed. Your target is the next weekly high, which is 150 pips away. You risk 30 pips to make 150. That's a 5-to-1 trade based on solid higher time frame structure. You enter the trade, and within the first few hours, price moves up 20 pips. You're feeling good. Then the 4-hour chart forms a bearish engulfing candle. Price starts pulling back. The 15-minute breaks, structure bearish. You're watching your unrealized profit shrink. 20 pips becomes 15, then 10, then 5. Then you're back to break even. Then you're down 5 pips. What do most traders do here? They panic. They think, I had a profit and now I'm at a loss. I should close this before it gets worse. So they close the trade with a small loss. And then what happens? Price bounces right off the 4-hour order block within that daily order block and proceeds to run 150 pips to the target. Without them, what should you have done? Nothing. Absolutely nothing. Your stop was 30 pips away. Price only pulled back 5 pips against you. The daily structure was completely intact. The weekly structure was completely intact. You were experiencing normal volatility within a valid trade setup, but because you let the lower time frame noise get in your head, you talked yourself out of a winning trade. This is why I hammer home the importance of trusting higher time frames. Not hoping, not wishing, trusting. When you do your analysis correctly, when you identify valid higher time frame structure, when you enter at the right zones, you need to have the conviction to see the trade through. Otherwise, why are you even doing the analysis? Why are you spending hours studying charts if you're going to ignore what they're telling you the moment you face any adversity? Now, let's talk about the opposite problem, because it's equally destructive. Some traders trust the higher time frame and use it as an excuse to hold losing trades way past their invalidation point. They're in a long trade, the daily structure breaks bearish, the weekly's rolling over, and they're still holding because the monthly's bullish. That's not discipline. That's delusion. Trusting the higher time frame doesn't mean ignoring when that time frame tells you you're wrong. When the structure breaks, you get out. When your thesis is invalidated, you exit. You don't move your stop. You don't give it a little more room. You don't rationalize why this time is different. You take the loss and move on. The difference between holding a trade through volatility and holding a trade past invalidation is everything. One is discipline based on structure. The other is hope based on denial. Learn to distinguish between the two, or you'll blow up your account trying to prove the market wrong. Here's what proper trade management looks like with higher time frame bias. You enter based on higher time frame structure. You hold through lower time frame volatility as long as higher time frame structure remains intact. You manage the trade based on higher time frame levels. Maybe you take partial profits at the first higher time frame target and let the rest run to the next. And you exit completely when either your target is hit or your structural invalidation point is breached. Simple, clean, unemotional, based entirely on what the market is doing, not what you want it to do or what you hope it does or what you fear it might do. The market doesn't care about your feelings. It doesn't care about your bills. It doesn't care about your profit targets or your account balance. It's going to do what it's going to do based on institutional order flow and market structure. Your job is to read that structure correctly and trade accordingly. Let's address another form of discipline that traders struggle with: staying out of the market when the higher time frames aren't giving you anything. This is actually harder than taking trades for most people. Sitting on your hands, watching the market move, seeing other traders posting their wins on social media, and resisting the urge to jump in just because you feel like you're missing out. But here's reality. You're not missing anything. Those traders posting their scalping wins, the majority of them are either lying about their results or they're showing you their winners while hiding their losses. And the few who are actually making money consistently scalping, they're not fighting higher time frame structure. They're working within it. When the higher time frames are conflicted, when you don't have clear alignment, when the market is chopping around in a range, The disciplined response is to do nothing. You don't try to trade the range. You don't try to pick the breakout. You don't try to catch every wiggle. You wait, you study, you prepare, but you don't risk capital in low probability situations. I've seen traders have incredible months where they take maybe 5 trades total. 5 trades in an entire month, and they're up 10%, 15%, 20% on their account. Why? Because those 5 trades were high quality setups with perfect higher time frame alignment, optimal risk reward, and room to run. Compare that to traders who take 50 trades in a month and end up break even or down. They're working harder and making less because they're taking low quality trades based on lower time frame noise instead of high quality trades based on higher time frame structure. Quality over quantity. Always. This is not about how many trades you take. It's about how good those trades are. And the only way to ensure your trades are good is to demand higher time frame alignment before you ever think about clicking the buy or sell button. Here's your final discipline challenge. Accepting that you're going to miss moves. You're going to miss them all the time. You're going to do your analysis, identify a potential setup, wait for your entry, and price is going to take off without you. You're going to see a pair run 200 pips in a day and you're not going to be in it. And that's okay. Actually, that's expected. You cannot catch every move. The market is not a buffet where you sample everything. The market is a shooting gallery where you wait for your shot, take it when it's there, and let all the other targets pass by. The trader who tries to shoot at everything misses everything. The trader who waits for the perfect alignment hits their target consistently. Your edge in this market isn't your ability to predict what price is going to do next. Your edge is your ability to recognize when the conditions are right for a high probability trade based on higher time frame structure, and your discipline to only trade in those conditions. That's it. That's the entire game. Everything else is noise. So let me leave you with this. Every time you sit down to trade, ask yourself, have I done my higher time frame analysis? Do I know what the monthly, weekly, and daily are telling me? Am I trading with that bias or against it? Are the time frames aligned? Is this a high quality setup, or am I just bored and looking for action? If you can't answer those questions with complete confidence, you have no business placing a trade. Close your trading platform, walk away, come back when you have clarity, because trading without clarity based on higher time frame analysis is not trading, it's gambling, and you're going to lose. The market rewards patience. It rewards discipline. It rewards traders who respect the structure and wait for their setups. It punishes impulsiveness, greed, fear, and traders who think they can outsmart institutional order flow with clever tactics on the 5-minute chart. You already know what you need to do. You've learned the hierarchy. You've learned to read the institutional narrative. You've learned to align your decisions with higher time frame bias. Now you just need to do it. Day after day, week after week, trade after trade. Trust the process. Trust the structure. Trust the higher time frames. Because at the end of the day, the higher time frame is always right. And the only question is whether you're going to trade with it or against it. Choose wisely. Your trading account depends on it. Now get out there and start trading like a professional. Respect the higher time frames, wait for alignment, execute with precision, manage with discipline, and watch your consistency transform. You've got this. The knowledge is there. The tools are there. The only thing left is your commitment to actually implementing what you know. Stop making excuses. Stop looking for shortcuts. Stop hoping the market will give you what you want. Start doing the work. Start following the process. Start trusting the higher time frames. That's how you win in this game. That's how you build wealth. That's how you become the trader you know you're capable of becoming. The market is waiting. Your opportunity is coming. The only question is, will you be ready when it arrives?